Hello, my name is Stephen Flood. I'm the CEO of GoldCore, and thank you very much for joining me today for the presentation Fear and Loathing in the Age of QE and AI. So without further ado, let's get started. Quotation from a mainstream research house, Goldman Sachs, that came out this year, and I think it really underscores a shift in the approach and understanding of what precious metals are to investors today. So they started off and they said the lower real interest rate in turn reduces the opportunity cost of holding a real asset like gold. So lower interest rates make it quite attractive, leading the market to bid up gold prices. So at the core, gold is a hedge against debasement, which is why we have termed it the currency of last resort. And when they say debasement, they mean currency debasement. So I think it's quite an interesting quote, and we'll come back to that later on in the presentation as well. Moving on, I just wanted to outline some of the conversations we have with our clients all over the world. And I wanted to try and figure out a creative way of presenting them in terms of risk, in terms of the effect on our broader economy, and also the effect on the gold prices themselves. So on the left-hand axis there, you'll see impact. So the higher up the impact axis, the greater the importance of a particular event. And then on the bottom axis, you'll see proximity. So where it is relative to today and where we think it's going to be if it's going to be on the horizon and where it's going to be. So starting off, one of the most interesting topics out there is quantitative easing, the printing of money, the reflation trade, you might call it, and this has led to an enormous rise in asset prices around the world. But has it been fair? Has it been equitable? Arguably not. Brexit is also a major issue that's on the horizon right now. Obviously, we're working through the various different machinations of that. There's a lot of political problems in Europe and also Britain, and especially with British leadership. So that's one to watch. Mobile technology generally is sweeping the world. I don't know if you guys commute to work, you probably notice that everybody is stuck on their mobile phones pretty much all the time between home and work, and it's becoming a very common sight, and it's going to be more and more important in terms of commerce, in terms of transactions going forward. Cashless banking is coming in. We recently attended the Web Summit in Portugal, and it was very evident that major banks are being disrupted through cashless banking industries and fintech and payment processes that are really changing the landscape when it comes to banking. And cryptographic currencies are also a big part of this story as well, so it's definitely one to watch. European cohesion is a topic we talk a lot about with our clients. A lot of people are very concerned about it. They don't think Europe has that cohesion to really make it through the next period of years. There's an awful lot of concern, especially with Lombardy and Italy, with Catalonia, with Britain leaving. These stories you couldn't have even suggested them 5 years ago. Now they're very much part of the fabric and definitely don't bode well for the future. So something really needs to happen in Europe if that's going to be addressed. Trump is obviously, his impact has been seen to be a lot less. Some would be quite happy about that than had been previously suggested. So I suppose there's two different types of Trump concepts. One with does he not have a war, or does he have a war? If he does go to war, whether it be with Iran or North Korea or somewhere like that, it could be have major global impact. So it's one to watch as well. Populism is on the rise. It's a very interesting concept. You can see this in the election of Trump. You can see this in the rise of Corbyn in the UK, in Macron in France. You can see it in the rise of the far right in Germany and also in Poland. You have issues in Italy, Spain. It's amazing what's happening around the world. And in truth, it's probably more about the erosion of the middle classes and their spending and their security. They are being squeezed by more debt on one side and less earnings on the other. They are anxious. They are voting for solutions, and they're looking to previously untested political parties and people. And it doesn't. In the past, when we've seen this, we have had some very serious outcomes. Not to say any of those previously mentioned political entities may not do a good job in the future, but it does show that people are under a lot of pressure. So it's one to watch, populism. Demographics, in the West is getting older. There's a major problem in our retirement profile in terms of who's going to pay for the older people in the next 30 to 50 years, and will there be any social protections there to help people? Will Social Security be there? Arguably not. So it's definitely something to be looked at. Inflation, I think, is going to be a very, very big and important issue going into 2018. It's rising in a number of economies as all of this printed money. I think it's estimated about $20 trillion has been printed by central banks, still printing about 200 billion a month, and ultimately, this will lead to inflation. Central bankers think that they'll be able to control that by raising rates. If they do, then what's going to happen to our economies? It's a very, very serious matter. But we think inflation will push the Fed to start raising rates because they really need to raise rates as fast as possible, so they have some sort of ammunition to tackle any future crises, which I'm sure they're very, very worried about because the rates are still on the floor. And then if they do raise rates, that could lead to a debt bomb. Excuse the elaborate language there, but I think the amount of debt in the world has become endemic and serious, and it's going to be very destabilizing should interest rates rise. Is it serviceable? And what happens if it breaks up? So debt bomb, I think one to watch in terms of what happens if we do have interest rates rising is China. China is definitely somewhere that has experienced enormous growth in leverage and is untested in terms of managing an economy that is contracting. BRICS are also important, and obviously how they manage themselves, and can they create synergies and bolster their local economies. So we'd look at that too. Digital democratization. This is a very interesting concept, and it's definitely something you can look at in terms of blockchain, in terms of Bitcoin, in terms of distributed ledgers, in terms of disruption, right across the entire, I would say, services landscape. Anytime, anywhere, people are validating information, validating customers, transacting, conveying, auditing, banking, all of those industries are going to be up for massive, massive disruption. Some will have huge gains, some will be completely gone, and the concept of the office worker is under threat, and that's going to have massive implications for our economy and our social fabric. So the big one is artificial intelligence, and this is something that we're watching very closely. It's a very important theme. We saw there Putin coming out recently and stating that the country that is able to have the best artificial intelligence could, in effect, rule the world. And I don't think that is too far from the truth. I think that's actually a very, very apt comment to make. Artificial intelligence really is the next step up in computer technology and its application, and it will be a massive disruptor in our society, and something that will provide huge benefits, but also a lot of change, and we have to come to terms with that and what that means. Elon Musk is someone to watch in this respect, and some of his warnings in this respect. So we can see with this chart that I have on the screen here, just looking at the debt relative to GDP, we can see that debt is rising, and not just numerically, but also from a relative perspective in terms of the global domestic product that we're producing. So we're at historical highs, and we're not at war. Typically, your debt would rise relative to GDP when you're in wartime. We're not, and yet we're still leveraging up at an enormous rate. Over here, if we break down that debt, you can see that towards the crises, banks deleveraged. That's the top line there, but non-financial corporates, that is businesses in general that aren't banks, they continued to leverage up. And you can also then see that the government, the red line, has been rising at an extraordinary rate, which is us. It's a proxy for ourselves. But our own household balance sheets have gone sideways, which is quite interesting as well. So households aren't really leveraging up, so they're not really participating in this economic boom to the extent that maybe others are, such as companies and maybe governments. Next slide here, we're looking at just another kind of look back in terms of debt, and you can see that point I was making about wartime debt, World War II, World War I, Civil War. These were spikes in our debt to GDP, especially in the United States. But yet we're doing the exact same thing again now. So, and this is a very dangerous situation where we're not keeping our powder dry. You want to be able to leverage up in times of economic uncertainty, but do you want to be doing it when the stock market is humming away and consumer confidence is growing? So it seems not to bode too well for the future. So just moving on, another slide here quickly. The printing presses are still humming, and you can see the amount of central bank printing that's going on now. It's estimated about 200 billion a month, which is extraordinary. This is essentially another form of taxation. When they print money, they debase or devalue the money that's in your after-tax earnings in your savings account, your pension account, and they hand the money to other specific channels. They could be very, very selective. They could be private equity, banks, and they get them to bid up asset prices for a very, very select few of the population. This creates a lack of social cohesion and social strife as well, which I would argue that we're seeing in our political landscape. So it's an interesting one to watch, and it doesn't come without its a unique set of costs. Now, this is the chart. It's a fantastic chart. Far too much data points here. I'm breaking every rule by showing it to you, but it does actually show some very interesting things. It's the gold price from 2002 across the major currencies in the world. You can see obviously the green and the red. It's not been a straight line. There's been ups and downs. But what I'd like to draw your attention to is the bottom line, where you see the average, and you can see in the US dollars case up until 2017, just recently, it's about 11.3%, and the Aussie dollar 8.3, Canadian 9.5, and so on and so forth, and the euro 9.4. Different currencies, different economies, different parts of the world, but they're all rising. Gold is rising in all of those currencies by a fairly standard 10%, I would argue. And you have to ask yourself, why is that? Is that have all these economies suddenly decided that gold is the best thing to invest in? Well, no, actually. Probably the biggest part of that is the printing of money and the devaluing of those currencies relative to gold. So it gives the illusion that gold is rising in price, whereas in fact a bigger part of it is actually the debasement of those currencies. Gold is probably reacting to a debasement in those currencies, and as of the house prices in those economies, arguably, and some of the stock markets as well. But just to kind of measure, to give sort of a relevance to these statistics, I added in here on the right, and I know it's not pretty, but basically this is the rise in health insurance premiums for a family of 4 in the United States from 2002 through 2016-17. And you can see that the annualized average price at the bottom is 13%, which is very much in line with the gold price. I think that underscores that what we're seeing here is just currency debasement. It's pure and simple. This is a manufactured state of affairs. Moving along, I just wanted to overlay the stock market, recent stock market prices with the central bank's printing of money, and you can see it's a very interesting stat here. It's 1 for 1. This is the central bank's balance sheets, I believe it is, and you can see that they are moving in lockstep with the stock market. Unemployment rates. This is quite interesting. This is a chart from the Federal Reserve of St. Louis, and you can see from 1970s all the way to now, when unemployment drops down to the floor, arguably full employment, it pretty much is predictive of a recession. Now, we could go sideways on this and continue on at 4%. It's at 4.1, 4.2% at the moment. It could go continue from here, but I do think, looking at the period of time between recessions, it doesn't bode well for maybe Q1, Q2 2018. I'm not making a prediction, but it does look like we have tapped out in terms of full employment, and we might see some anxiety and maybe some sort of contraction in the economy. If I overlay this is the US, by the way. If I overlay this, you can see with the stock market, the Wilshire 5000 price index, you can see the inverse correlation between these two, and I think it's fascinating. You're looking basically at the stock market rising up as more people have jobs. There's exuberance there, but if that job number was to turn around, you can only imagine what would happen to that stock market line there as well. So it's very interesting. But again, overlay this with something which I think is very interesting as well, is the velocity of money in the economy. M2 money stock. This is the rate of transactions with a dollar in the US market. It's the red line there, and you can see that it's an all-time low essentially. And if you look at other periods in the economic cycle after recession, it tends to rise in the 1990s. There's a bit of a bump in the 2000s, 2005, but after the last recession, the velocity of money changing hands dropped and kept dropping and has not recovered, which is very concerning. Which means that I would postulate that this means that the common man is not participating in the economic recovery. They're still under a lot of stress and pressure. Their jobs aren't as good in terms of quality that they may have had before, and they're certainly not spending that money and moving it around the economy. So I think that's actually quite a serious problem that we have. In terms of predicting the gold price going forward, you can see here the US dollar index has come off its highs of early 2017 and late 2016, and you can see the dollar is reacting to that as well. So the gold price is reacting to that. It's moving up in a very strong formation there. I think it's quite bullish. I really do, and I think the dollar index is coming off as well. So it's one to watch there as well. But in terms of predictive power, this is, I think, one of my favorite charts. This is the investors' expectations of inflation in 10 years time, and it basically is extrapolated from looking at the 10-year treasury rates and the pricing of those, and you can overlay this with the gold price, and you can see a very strong correlation between the two, and this would imply that investors think inflation is coming and the gold price is moving, is supportive of that. So it's very interesting indeed. So 2018 outlook from GoldCore. So just talking to our clients, Trump, no matter where you are on the political spectrum, there's a lack of respect there. I think there's a lack of capacity to execute a lot of his policies, and there doesn't seem to be a cohesive strategy. He does seem to be politically naive. He's retrenching back into the U.S. market, and the market seem to be just happy to let him go about his business as long as he doesn't actively sabotage their own agenda. So let's hope he doesn't get too creative and start a war or anything like that. But so far so good. He hasn't derailed the economy, which is good from many respects. And we'll see where it takes us. In terms of Brexit, I think it's a very important thing, especially from a European perspective. It's going to be a big story in 2018. Medium-term pain, long-term gain. Cameron may be seen as an accidental hero, and I know this is not particularly popular, but if Europe does break apart due to the lack of cohesion within it, and also the bureaucracy, which is utterly detached, as far as I'm concerned, from the people. Most people I know don't even know who their MEPs are in Parliament in Brussels, and they don't know what their policies are on almost any topic. We have regulations hoisted upon European countries which have never really been discussed at a local level ever. So it really operates and beats to its own drum. So it's one to watch. So I think Brexit, it might be very tough, but if they get out before Europe collapses, then it's maybe it'll actually have worked out really well for them. Europe, poor outlook, lack of cohesion, the rise of the right, which is very concerning, and if we do have rising interest rates, what happens to the euro debt crisis and other countries? Rates, the Fed wants to raise them, likely we're going to have some taper tantrums, especially as the debt levels grow. And market liquidity, this is a very important one. I think the market is operating somewhat blindly at the moment, because we have these bad actors in the market. We have central bankers bidding up asset prices. The Japanese central bank are one of the worst in this respect, and we also have passive funds who buy no matter what. They just buy the market as money flows in. They don't look for growth or value or whatever. They just buy everything that's in that basket. And then you have the algos as well. So the actual open market market there where buyers are bidding and duking it out for stocks, and valuing and has been eroded to a small percentage of the market. So caveat is we live in very uncertain times. There is no map. So going beyond that, generally demographically we are getting older and we are getting fatter in terms of debt, and so an older aging population with a larger debt burden doesn't bode well for the future. This needs to be tackled somehow. Obviously there's a number of things that can be done, but it is a trend that we see. We're becoming less useful in respect of new technologies that are coming on and may replace us. So AI, I spoke about that earlier, with all of those jobs in the services sector, in the white collar workers, and we're also becoming a little dirtier. Our climate's changing. Well, depending on where you are on that, I know a lot of people don't agree with that, but there are a lot of people do, and there's an awful lot of science to support it. But it is a big concept, and whether climate change is man-made or is part of a natural cycle, it does seem to be with us. And also less fair. We have the asset price, the reflation of assets has benefited a marginal few at the expense of many, and that is creating social strife and political upheaval, and that's something to be aware of. Again, it doesn't matter where you are in the political spectrum. That's a fact. So it's a good time to own a hedge that cannot be debased by men, i.e. central bankers who are unelected. Ergo, we suggest that you have an allocation to gold. When you're doing that, there's some do's and don'ts here. Do's, always allocate, this is up to you now, obviously, and you talk to your financial advisor, but an allocation of 3 to 10% can make a lot of sense. And non-home investable assets, and you can invest a number of different ways. We have a number of really, really great ways of doing that. There is a lot of academic evidence that actually pushes that 10% up to 20%, depending on who you read. And if you're very anxious, you could go beyond that. But typically 3 to 10% will be a long-term comfortable range for asset allocation when it comes to precious metals and gold in particular. Long-term, always own segregated gold, i.e. don't buy, well, you can, there are a number of different forms of gold you can buy for when you're speculating, where you own a part interest in a gold mine, or a part interest in a bar of gold that you share with other investors via an ETF or a digital gold provider. They're fine. They're going to be fine most of the time. But if you're doing it for long-term hedging, then you need to own segregated allocated gold. And I'll cover that in a second. So as I just mentioned there, speculating, there's a number of options out there, and they're cheap to buy, cheap to hold, cheap to sell, but they also come with some interesting qualifications, and you have to be aware of those if you're looking to hedge risk. They may not be the best way to go. Do not seek safety in bonds or cash only. You must diversify your holdings across different asset classes, and depending on where you are in that investor life cycle, I would strongly advise you seek counsel with a fee-only investment advisor, and get a plan for the future that takes into account your family's requirements. Trust banks fully. Well, no, don't. Look up bail-ins. Your deposits are at risk, and if there's a workout, a capital restructuring of banks in the future, and if debt, and I strongly believe there will be, bail-ins, bail-in tools, which are in our legislation right across the West now, will allow the authorities to confiscate cash from a short-term or long-term perspective, and use that cash to recapitalize banks. It's a complete and utter con, and it's something to be aware of, especially if you have large deposits. You need to have a strategy around that. You can always talk to us, and we'll give you some ideas. Buy for capital appreciation. No, you don't buy gold for capital appreciation. Actually, if you're hedging, you're inviting disaster. So if you put 10% of your money into gold as a form of financial insurance, the factors that are pushing it up in value will push the other 90% of what you own down, and you have to be aware of that. So you buy your gold long term. Don't look at the price. Leave it there. It will serve as a foundational asset for your portfolio, and that's the way you should look at it. Long term, and buy a good quality gold. Always seek independent financial advice. Moving on, from that Goldman Sachs report, there's another part of it. The importance of liquidity was tested during the collapse of Lehman Brothers in September 2008. The lesson learned was that if gold liquidity dries up along with the broader markets, so does your hedge, unless it's physical gold in a vault. the true hedge of last resort. I think that's a fantastic quote, again from a very interesting party, some mainstream investment house, and it really nails it. And it is a hedge of last resort because it's there, it's out of the system, it's no one else's liability, and that's a critical point to remember. Moving along. In terms of buying gold, as I said, there are low-cost options out there. Lots of ETFs, lots of mining companies, lots of digital gold providers, and they are great most of the time. But if you are about hedging, low cost also equals low utility. And when I say utility, options, can you take delivery? Can you go and visit your gold? Can you sell it to multiple parties, not just through one single platform? And that's really important. What if that platform crashes? What if is it what they call in technology terms a single point of failure? With GoldCore, you have that metal sitting on a shelf in Zurich. It gathers dust until you say otherwise. You can go there and visit it. You can put it in your hand. You can drive away with it. You can offer to sell it to GoldCore, or you could, if you don't like the price we're offering, you can go and direct it towards another dealer. It's your asset. You own it. We should not be able to hold you captive. So just remember that it might be easy. You might see a fancy iPhone app allowing you to buy gold or cryptocurrency or something like that. But the underlying assumption is that there's always liquidity there. There's always a provider able to deal with you, and that's not always the case. And we've seen that many times in history. So remember that low cost gold might equal low utility gold, and that's something to remember. So now for some GoldCore key facts and figures. As you know, we were established in 2003, so we're one of the oldest modern precious metals dealers in the marketplace. Long established, lots of client history there, and we enjoy a very high client satisfaction rate as well. So we've got 15,000 accounts opened in about 140 countries, most of which are UK and Ireland. We also have quite a lot from the United States and growing in Central Europe as well, in Germany and countries like that. We have about $140 million worth of assets under management. We did reach $1 billion in sales recently, and primarily we offer investors access to bullion bars and coins. We also offer Perth Mint certificates as well, which are fully guaranteed by the Western Australian government and are very, very popular. But when it comes to storing physical gold on a segregated allocated basis, most of our clients will look to store in Zurich, which is very popular, London, Singapore, and also Hong Kong. We are obviously a specialist in segregated and allocated storage accounts, and you can see some photos of our headquarters there in Dublin, Ireland, and also our sales office there in London. So thank you so much for your time today. I hope you enjoyed the presentation. You can see some contact information there, my email address, and our UK, Irish, and US phone numbers. So do feel free to reach out if you think we could be of assistance. We'd love to hear from you, and thank you very much for joining us today.